Top three things in my notebook this morning. Number one, Italy. Number two, Russia. And number three, U.S. stock market sentiment. So first on Italy. Italy's really driving, in terms of our process at least, it's driving home the message, which is strong euro creates stronger purchasing power, confidence levels, et cetera, and consumption growth. And you can see this in the data now. You can also see it in the Italian stock market. So instead of banging your head against the wall, trying to figure out whether or not the Dow Jones will be up or not year to date, Italy's stock market's up 8.5% for the year to date on accelerating consumption growth data as opposed to what you have in the U.S., which is, of course, U.S. growth slowing data. So Russia, at the end of the day, it had its bounce. There's a little bounce within the construct of a market that's crashing both on the currency side and on the stock market side. But, I don't like what I see from that bounce. We're immediately back down again this morning on the Russian Trading System Index. The envelope is opening up to the downside in terms of where the stock market could go. Don't forget that the Russian stock market is still, inclusive of yesterday's bounce, down 18.3% for the year to date, which makes it the worst performing stock market in the world year to date, which would make sense given that they are in fact burning their currency as well. Now finally, U.S. stock market sentiment. We're right back at the all-time highs in the U.S. stock market, but more importantly, both the VIX from a front month perspective and the bull-bear spread, which I pay a tremendous amount of attention to, but the bull-bear spread is right back to where it was, which is right around its all-time highs. So again, all times is obviously a long time for both the stock market but sentiment. So again, it's not like last year when we were telling you to buy stocks, growth was going to accelerate, dollar rates rising, the whole shebang was in the bag, and at the end of the day, sentiment was very bad. Now sentiment is uber bullish. The bears aren't even allowed to come out and short stocks. You have only 15.1%, which is a new generational low on the bear side of that survey. 15.1% of people admit that they're bearish. So I'll add myself. Obviously, we continue to add ourselves to that pile. And again, if you look at the sector, the styles or the variance at the stock level, we continue to think that this looks like the first quarter of 2011, where utilities, gold, and bonds continue to lead the rally in the face of consumption-oriented assets and stocks failing and really underperforming at a very obvious level. So those are your top three things.